Good morning, it is Thursday, August 13th. Here's what's on the agenda. Stocks and bonds on the front foot as US inflation eases. Korean stocks close in on bull market territory as the AI hardware trade roars back. And as Iran and heatwaves snarl global trade routes, we're going to speak with the CEO of shipping giant Maersk, which has raised its guidance off the back of an earnings beat.
Let's talk about where we are with these markets. Tom, we're not doing what we're seeing in Korea here in Europe, but we are up. We're up by 0.4%. The tailwind out of Asia, out of the United States looks good. Plus the earnings picture, Maersk, looking good as well. Dollar yen not reacting that much to the story this morning. The Takaichi government in Tokyo is suggesting it will back a faster clip when it comes to rate hikes out of the BOJ. We'll look for that one. Maybe it's getting a little bit of traction. And Brent's not really doing very much this morning. We're oscillating just below the 90 level. 88.91 is where we are trading right now. Lots to talk about. The countdown to the opening trade starts right now.
Well, let's start with the macro then and the inflation story out of the US, because CPI was pretty benign, no surprises. What you do, though, have is a reaction from the markets now, an expectation that there's about a 30 to 35% chance that the Fed goes with a hike. So that's pared back significantly from about 50%. This is for the month of September, of course. So no surprises from CPI, but you couple that with weaker jobs, you get producer prices out later today. But the view from traders seems to be that this is a Fed that will be on hold. We have the August data we have to wait for, of course. But is that where we land? And also, what do we make of the auctions in terms of the 10-year yesterday, the 30-year coming up today? Guy?
I'll get Scarlett's take on this. Yeah, go.
Yeah, sure. I mean, I think there's still a hike price this year, right? We haven't moved away from tightening entirely. What's interesting is the two-year yield hasn't been that buoyed by the lower inflation. And I think if you look further out, it's very concerning on the yield curve in terms of you had the 10-year auction yesterday that had the highest yield since 2007. And we're going into a 30-year auction later today, knowing that there's a lot more issuance, not only from governments, but from AI, and that's longer duration.
There's so many things going on here. The CPI I thought was a non-event. A complete nothing burger, I think as Cameron Crise put it yesterday. We've still got Jackson Hole to go. That's at the end of August. That's going to be a factor which will tell us a lot about where the Fed thinking is currently. You've still got more data to go before
Although
September.
Walsh won't say anything at Jackson Hole.
He might. He might give us some clarity. You could be right, you could be wrong. I don't know. But it's a big Fed event that is still coming that may give us some sort of a sense of clarity. I thought the auction yesterday was fascinating ahead of a big auction today on the 30-year. Did you see the deficit data out of the United States yesterday? Huge number coming through in terms of what we are watching at the moment. I think it surged in July. We are well ahead of expectations in terms of where the US deficit is. The government borrowing rate is extraordinary at the moment, and most of it is coming in the form of debt servicing. That number is going vertical right now. It is a major problem for the United States at the moment. The US, I think the scoring on this assumes a 4.1% US 10-year. We are well north of that.
I mean, absolutely. Yeah, I think it's interesting. The St. Louis Fed did a paper, and essentially government bonds are meant to have a convenience yield, but it's turned into an inconvenience yield in terms of it doesn't provide you anything special and actually takes up your balance sheet. So, why would you hold it? It requires a higher yield as a result of that.
$3 billion is what they're having to spend at the moment daily on debt financing in the United States.
$3 billion every day.
So just kind of put that in context of kind of what $3 billion buys you and tells you how big a problem this ultimately is. And then you fold in the Japanese story this morning. Takaichi saying, you know what, you can go.
This is a Bloomberg scoop.
Yeah, this is a Bloomberg scoop. You can take rates higher at a faster clip in Japan. Maybe that doesn't change very much, but at the margin, it's just an extra little bit that says, don't buy treasuries. There are other things out there. So the picture doesn't look particularly good this morning. So I think CPI was interesting, but I think the bigger picture is really problematic.
Are we surprised the yen hasn't moved more, given the pretty benign picture on inflation out of the US, and then this reporting that Takaichi is open to a faster pace of hikes from the BOJ? 159.
Do we need to see the actual rate hikes before we?
Well, I mean, there's something like 20 basis points priced for September for the Bank of Japan. he's telling you that you need more hawkishness to get a significant
I think we need to hear
upside.
from the BOJ. I think there needs to be a clear kind of indication at this point that we're going to be seeing that coming. Lots of headlines in tech this morning. Lenovo shares rising 20% in Hong Kong after a revenue beat. That's one of the ones that really stands out to me this morning. Look at what's happening with the Kospi. It's roaring back. You are seeing the AI trade back on with a vengeance when it comes to the Kospi. What are we, back in a bull market now?
Close to that.
In a bear market, we're getting close to that. This is like extraordinary scenes, you could argue, in some ways, in terms of what we're getting. And the US tech story is strong as well. You're getting deals getting done. We're still, I think, reacting to the big NVIDIA story about the securitization of GPUs. I'm getting so many emails and WhatsApps about that story, about how confused people are by it and how it doesn't make sense and how worried people are by it. But basically, the narrative is still front foot, AI trade on. And that seems to be being reflected once again in share price.
You mentioned the deal making. There's the Anthropic biggest acquisition it would be for this company that's leading up potentially to their IPO. September, October is the market rumour right now for Anthropic. This is a potentially $6 billion deal for Decart AI, which produces software that interestingly reduces the cost of training AI. You're also seeing, importantly as well, Grok, so Musk's company, coming out with a new model 5.6, which on some measures is about 80% cheaper than some of their competitors from Anthropic and OpenAI. So it just brings back to the fore that question around falling prices, falling token prices. Interestingly, as the open source story in China, you're seeing some evidence that open source is becoming a little bit more pricier in China. So maybe there's some convergence there. But overall, cheaper token prices, that tying into the AI story as well.
I mean, yeah, I think also it's positive that you've seen the kind of feed through from inflation data to sentiment in Korea in terms of it's seeing as a positive driver, despite we had some more negative earnings overnight out of the U.S. and Cerebras and Cisco in terms of that forward guidance being more negative. The other thing that we're still really looking at is the oil market, right? We're still in a stalemate where the U.S. and Iran can't come to a deal over the Strait of Hormuz, and the U.S. has come forward and said essentially that they're going to use economic sanctions as a way to pressure Iran, as well as a blockade on the Strait. Now, I mean, it could work. I think the issue is economic sanctions have been in place for quite a while now, and it hasn't worked. And in the meantime, the Strait is still closed. And so we've had this turn in the oil market. Yesterday was a little bit more positive with oil prices down. But that's following 6 days of rising. And so, it means that you've got a churn in the market. You've still got gas prices high and a 1.8 million barrel a day shortfall, according to the IEA.
Does that show up in next inflation data? Presuming it will. You're going to start to continue. You're going to continue to see that as being a significant factor, taking you back to the inflation story. Yeah, I don't know what happens at some point when we all come back in September. We're already here, but when everybody else comes back in September, I hope you're out there. Are we going to suddenly start to see a moment where everybody goes, "There's nothing left in the tanks. We're not getting the oil out that we need. We've still got relatively high economic growth, particularly in the United States, but broadly globally." Are we going to get to a crunch point? How easy would it be to get from 90 to 100, 100 to 110? It doesn't feel. It feels hard at the moment, but you wonder when it happens if it could come quite fast.
And maybe it's worse right now because we're not at very high levels. In terms of if you had very high levels, you'd have more demand destruction.
Yeah.
Whereas now it's focused in EM.
And China's changed its narrative as well. Mm-hmm. It's not acting as. It's not pulling out of tanks. It's pulling in from its suppliers, and that adds an extra bit into the market. A
crucial factor, the China story, in terms of how they react. As we think about fuel, oil prices and energy prices, fuel prices in focus. Worth reminding ourselves that freight rates are up about 70% or so since April, and that brings us to the story from Maersk. Obviously, benefiting from the freight rate story, they see. So the line's crossing a couple of minutes ago. Full year underlying EBITDA at the top end, $12.5 billion US dollars. The estimates had been for 9.3 billion. So it's a solid beat in terms of the expectation, the full year guidance coming through from Maersk. In terms of some of the individual lines coming through. Second quarter, worth noting, revenues coming in again, a decent beat, let's call it 15.8 billion US dollars. The estimates had been for just above 14 billion. So it's a solid beat on the second quarter, but it's the guidance that is going to be most in focus for investors, you would have thought. You can go through all the different units of this business, including terminals, but broadly, this is a picture of strength. Is it going to continue? Is there too much capacity when things resolve themselves around the Strait? If we get to that point, we're going to be speaking to the CEO, of course.
Or are we in a world where supply shocks are just going to continue to persist? Panama, an issue. Rhine, an issue. All of these factors, do they just continue? Are we just in a cycle of ever ongoing supply-side shocks? Talking of Maersk, hey presto, Vincent Clerc, the CEO, is going to be joining us shortly. Henrik Andersen, the Vestas CEO, it's a big Danish day today, is going to be joining us as well in the studio. Vestas smashed it yesterday. Huge move to the upside in terms of its share price. We'll get Henrik's take on that. Fabiana Fideli, M&G Investments, Equities and Multi-Asset CIO, joining us. Anton Osika, Lovable's CEO and co-founder. This is one for Tom.
Yeah, on some metrics, this is the fastest growing software company in Europe right now. Valuation of 13.3 billion. They've raised additional capital, so we'll be speaking to the CEO, one of the most valuable startups in Europe right now, talking of AI. Let's look ahead at what else we are watching throughout the day then. It is an election here in the UK, Clacton By-Election. At 10 a.m. UK time, it is Euro area industrial production data. That will be crossing. 1:30 p.m. UK time will round out the inflation story out of the US with producer prices of the core feed in to PCE, which is watched by the Fed. 1:30 p.m. UK time, producer prices, PPI dropping later. We're going to get some Fed speak from Beth Hammock and Tom Barkin. And on the earnings front, it is Applied Materials after market guy.
OK, coming up, Europe is set to be hit by its fifth heat wave of the summer. Basically, we're at peak temperatures today. River levels already at record lows across Europe. Is that a stream or is that a river? We're going to break down what it means for the continent's industrial sector. That is coming up. Plus, the European Union wants more of its citizens to buy stocks and bonds. They buy quite a lot of bonds already. How much more stocks can they buy? We're going to discuss the roadblock facing the EU's push. Plus, up next, Sri Kochagovadan, senior research economist at Aberdeen, is going to be joining us. You got any questions? Send them to us. IB+, BB, TV Go. That is the function, and this is Bloomberg.
We are around 45 minutes from the open of trade this Thursday. European futures pointing higher by 0.5%. You saw a down day for European stocks yesterday, snapping 8 days against. We seem to be on the front foot today. US futures also in positive territory. The picture in the UK, FTSE 100 futures pointing gains of 0.2, a slightly stronger picture flagged by the DAX futures looking to add 78 points. CAC current over in France currently up 0.2%. Turning to the latest out of the Gulf right now, as we see a little bit of softness on oil prices today. Prices taking a bit of a breather, then at around $88 a barrel, snapping a 6-day rally as traders wait for signs of progress on reopening of the Strait of Hormuz, if we get there, while talks between the US and Iran on ending the war remain in a stalemate. President Trump is betting once again that suffocating economic pressure will do the job. For more, let's bring in Bloomberg's Abir Abu Omar in Dubai. Abir, so a slightly different focus from the president, according to our reporting now. It's less about military attrition and more about economic attrition. Is there any evidence that it'll have an effect that will move the needle?
No, is the short answer, Tom. Good morning. So President Trump is going back on what essentially has started this whole thing, saying that he will exert economic pressure on Iran and that somehow this new approach would lead to some kind of resolution. Now, previously, in the past, this kind of approach has not really done anything when it comes to succeeding in forcing Tehran to bend on its nuclear program or release its chokehold on the Strait of Hormuz or pretty much anything else, really. So what we're seeing now is a return to the economic pressure. Now, this obviously follows a lot of news reports, including Bloomberg Economics suggesting that the U.S. is running dangerously low on munitions. So there is a danger of the U.S. going back to what is or what could be considered a full-scale war here in the Middle East. It might not be able to continue through with that. At least that is the suggestion from those multiple news reports. From the Iranian side, though, Tom, what we know is that they have promoted hardliners into the echelons of power in the government. That is a decision that was taken by the new Supreme Leader, Mujtaba Khamenei. Some of the hardliners that have now new roles in the government suggest that this new approach in Iran's government is a return to this offensive doctrine. So Iran is saying that it is ready for a return to military action. The U.S. is saying that is not the way to go. Now it's time for economic pressure. And it's not just President Trump. It's Scott Bessent also suggesting that that might be the best approach for the time being. But let's just distinguish between what is happening on the ground and what is the rhetoric between those two countries. And what is happening on the ground is that ships over the past couple of days into the early hours of this morning have not been able to make their way through the Strait of Hormuz. We have reported about that deal between Oman and Iran, and nothing has changed there. Still a lot of unclarity. We still understand that it is in the final stages of being reached. And so until that is done, until we have a formal agreement on what exactly will happen there, you're seeing oil prices moderate their losses. They were down 1% this morning and now just about 0.2% lower, Tom.
Up quite sharply on the year. Abir, thank you very much indeed. Abir Abu Omar joining us out of Dubai. Joining us now, Shrij Kochagovidan, Senior Research Economist over at Aberdeen. Oil prices are high. Inflation number in the United States, bit of a non-event yesterday, but still elevated and still above wages. What did yesterday's number tell us really about where the Fed's going? Because I got more data still to come. I got Jackson Hole still to come. Can I usefully extrapolate from yesterday into September and the rate decision?
I think there's still time, actually. We still have data to go. We still have Jackson Hole, as you say. But I think yesterday's number was actually quite reassuring in one sense. It was quite a soft print. It was very much in line with expectations. If you look at the components there, goods inflation is coming off. There are some components, AI-related tech, hardware. They're showing some signs of inflationary pressure. Wage service sector inflation, I think wage growth, with the labour market being softer recently, softer than we had previously seen, just in that last print, and wage growth being a bit slower, it does seem that the underlying trend is still on track for disinflation. But, as you say, it is above target. And we still have the Strait of Hormuz being closed. So we still have that inflation risk coming from not necessarily core, but to headline inflation. And I think what was interesting in the last Fed meeting was the dissenting voices. They were flagging the risk of inflation expectations. So I think that continued debate about energy prices. We've had persistent inflation for a long time now.
Yep.
And it's really important for voters, one, but it's really important for expectations. So I don't think it's completely a done deal that we're going to see a Fed on hold. It's still very much in the balance because of the tensions in Iran.
Okay. In terms of what that means for the Treasury market, yesterday we had an auction which showed the highest yield level since the GFC. We've got a 30-year auction coming through today. We've got some deficit data yesterday which pointed us towards the fact that the US deficit is large. In fact, it really surged in July. And servicing costs are massive at the moment. What is going to end up driving the 10-year? Is it concerns about inflation? Is it concerns about the deficits? Is it concerns about something else, geopolitical tension more broadly? Are we going to continue to see yields cranking higher and the yield curve continuing to steepen in the way that it is?
I think there's a combination of all, actually keeping that term premium higher from the 10-year, particularly in the long end as well. So it's a combination of inflation expectations, term premium, fiscal concerns as well. But yields are very attractive at the moment, so I think that's reflected in the demand. And I think today's auction will also be quite interesting to see what the bid-to-cover ratio is and how much demand there is. So it is at attractive levels, but there is a lot of issuance. There's no change in the funding plan, so that's a good thing, that we know what to expect. But there is a hell of a lot of issuance coming through. And as you mentioned earlier, it's not just from the Treasury, it's also from the corporates as well, all in the long end. So I think elevated yields within a range. Will it go much higher from here? It's difficult to see a ratcheting higher from here, but I say that cautiously.
You wouldn't rule out bond market vigilantes, a kind of bond market blow-up, bond market tantrum in 2027?
Not rule that out at all. I think that's the theme that we've seen for the last year and for the next year. I think with volatile data, volatile geopolitics, bond market tantrums are going to be part of the story. But also there's spillovers to other markets as well. So today's auction is actually quite important for Japanese bonds as well, because they are very correlated. There's a correlated theme of fiscal concerns, extra spending, how are we going to fund this? That affects UK, Japan and the US as well, and France. So
I mean, yeah, you've seen it very evidently in the yen, right? That fiscal concern weighing. And I really question, you've had massive intervention. You have a hike price 20 basis points in September now. So what happens to the yen if they don't hike, Bank of Japan?
I think the BOJ is critical for the outlook for the yen. So yes, we did see coordinated package actually from the Ministry of Finance in Japan and the US Treasury, and that was on the 30th July, very strategically timed, just after the Fed, just before the BOJ, and then you had the actual intervention, coordinated intervention. That was great for a few days, and obviously it didn't last. Why? Because the fundamentals just aren't there to support the yen. And really what needs to change is the rate differentials and the policy path for the BOJ. And I think today's headline that you just broke the news, that Takaichi's, that the Prime Minister's office has made a statement that they support BOJ independence and potentially rate hikes. It's their decision. That's actually quite important for JGBs and yen. And I do think that September is a live meeting for the BOJ. So I did have October. So when they hiked in June, just looking at the statement and the dissent and some of the political changes within the BOJ, I moved my call to October. So I think that's pretty much priced in. But I think September is live. And actually September would be a good thing for the yen.
Would it be a good thing? Would it be a good thing for treasuries? Higher rates in Japan, higher yields in the US on the long end.
I think partly.
What are you seeing in terms of, what do you expect in terms of flows?
In terms of flows, I think one of the concerns for treasuries or US assets was, what does intervention actually do to US treasuries? Are treasuries sold in order to keep intervening in the yen, and that's been a concern. So I think it was interesting that the US Treasury actually intervened, and we had that coordinated move, in part to protect US Treasuries. But in terms of flows, there is still that flow flows out from Japanese households or Japanese investors externally. But now yields are very attractive. The Nikkei is very attractive. So there is a shift, and also GPIF, that push from the government to invest domestically, I think will take time, but it could be quite meaningful. OK, so we'll continue to watch that. Shri, thank you very much indeed for those insights. Shri Kochav-Gindan, Aberdeen Senior Research Economist.
OK, what else do we need to know this Thursday morning? Germany's counterintelligence unit has warned of a coordinated Russia-linked influence campaign aimed at deepening social divisions ahead of regional elections next month. Germany's domestic security agency issued a document detailing a social media campaign designed to foment tension between the former East Germany and West. It comes as the country's far-right party, the AfD, is expected to make major gains in that election. As we were saying earlier, Europe's fifth heatwave of the summer is set to peak today. The highest temperatures are again forecast for France, which has been the epicenter of Europe's scorching summer and wildfires. Meteorologists there say a number of regions could reach 40 degrees Celsius. In the UK, the Met Office says temperatures in southern England, including London, could reach 37 degrees. And talking of the sun, millions of people crowded cloudless cities and towns in Spain Wednesday in search of the best view of this, a total solar eclipse, which is, of course, where we get the alignment of the sun, the moon and the earth. It briefly plunged parts of the planet into darkness. I certainly saw that. Spanish authorities said the eclipse was expected to draw at least 500,000 additional visitors. Did we watch?
My kids took inspiration from the Guy Johnson cereal box.
Excellent.
Tips,
yep, well
but
done.
They were underwhelmed by the image that was projected on a white. There was a lot of build-up in our household, and then there was this tiny little.
Yeah, my children were slightly underwhelmed by that as well. They were slightly overwhelmed by how dark it got, which I thought was fascinating. And we did have a sort of viewer, so you could see it. And the feed from the observatory was good.
I mean, I'm still adjusting to the new hours, so I was in bed.
Were you?
Yeah.
Happened at 7:30, Skylar.
I know.
That's even before my bedtime.
It's a disciplined sleep schedule, isn't it?
Yeah.
All right, coming up, we're going to speak to CEOs. It is. We could rebrand today as Denmark Day, really. We've got two CEOs, of course, of the largest companies, amongst the largest companies in Denmark, Vestas and Maersk. We'll bring those conversations to you. This is Bloomberg.
Okay, 30 minutes to go until the start of European trading. Looks like futures are on the front foot this morning. Feels a bit stronger than it has over the last few days. Last few days, it's been a complete nothing burger at this point. Today, actually, we've got a bit of price action to work with. The Asian session has been strong. US action yesterday, quite strong. Plus, we've got a whole bunch of numbers out this morning. Maersk is one of them, which are obviously of significant interest.
Yeah, more action in the equity markets than there are in the bond markets, certainly. There's stability in the European bond markets right now. Not a lot of changes. Of course, you had a little bit of a bid for US debt yesterday on the back of that benign inflation data. Not much of a read across here. 316 on the German debt, 398. That is unchanged from yesterday in terms of OATs over in France. BTPs largely unchanged as well, just below 4% at 394. Let's get to that earnings story the guy was nodding to then. Because the shares in Danish wind turbine manufacturer Vestas surged the most in 4 years yesterday. Quite the move after the company lifted its profit guidance for the year and announced a share buyback. Vestas also reported that total turbine orders rose more than 50%, 50, in the first half from a year earlier as soaring power consumption from AI data centres bolsters demand. Very pleased to say we are joined now by Vestas CEO Henrik Andersen. JP Morgan calling this a stellar, I'm quoting, a stellar second quarter performance. Henrik, thanks for joining us on the back of these numbers. Talk us through where that demand is coming through, where that order pipeline is coming through, and if there are challenges in terms of executing on that.
Yeah, I will say here, first of all, it's great to be here. And it's not very often I've, in the last 5 or 6 years, have had anything stellar related to the performance of Vestas. So I think yesterday was a moment. It was also a moment of joy for nearly our 40,000 colleagues, because there wasn't much we would have done differently if we could do differently in Q2. We executed on our projects. There is a high focus on execution. We work closely with all our partners externally from the supply chain, been able to mitigate, and that also means when we look at what we executed in second quarter, I only had to call somebody and raise the voice, I think said yesterday, to give people praise, because that was...
Is this the end of the turnaround story for Vestas? Are you back to, you're returning cash to shareholders?
Yeah, I think also a reaction of yesterday is probably that we have been able, or risk of being able to split a little bit the world in two. There were the people that didn't believe in it. There were the people that didn't see the turnaround actually happening. And every time we did better, it was like, oh, that's probably an exemption. So I think we probably came yesterday and sort of said, well, okay, fine, we turned the corner. And we now start talking about this, for me, holy target of 10% EBIT, which is only 200 basis points out. And of course, everyone can now see, hey, hang on. There are handles, and there are also more handles to get to 10% and the 200 basis points.
I see turnaround working for you, but not turning round. You don't go around corners on a wind turbine. Anyway. Out of the woods, then. That was another line.
Yeah.
So the firm is out of the woods. I've known you for a long time. We've talked about this business for a long time. Very tough a few years ago. It's got better and better and better. Are the woods behind you? Is it kind of...
Yeah, you can't say anything else. You got to say, and you got to believe in that this is the woods behind. But then on the other hand, I came in the board in end of 12 and beginning of 13. So I've seen cycles. This is a cyclical business, and therefore, of course, never say never. And therefore,
where are we in the cycle?
We are clearly on the upwards trend of the cycle, because what you can see is the fundamentals and the underlying. Then you can have all these emotional outbursts on sort of specific wind or energy sources, but the trend, the demand cycle is pointing towards something that is 15, 20 years out, and also cycle. It's a long cycle, and also you can see it underlying. I mean, you're in this country, you arrived last night. Most of Europe, people have suddenly realized having a transportation that is electric is beyond anything cheaper, and you don't need to switch your telly on and saying, actually, can I get my diesel?
Does AI keep the cycle going even longer?
I'm sure it does, but then the AI also gives you other things, because as part of the AI getting into everyone's supply chain and productivity, we will also see a much higher degree of efficiency. So buildings will become more efficient, the way we transport will become more efficient, the way we storage energy and not least electricity will become much more efficient. So we are welcoming that, and I think that's probably the positive with AI. So right now everyone said, we need to build more, we need to get all of this supply chain, we need to have more energy. But I'm pretty sure if we look at decades ahead, there will be things in the technology development that will also start working in the opposite direction.
I mean, another theme that is very much of this decade is the series of supply shocks that we've had, starting with Russia-Ukraine. We've had loads of them this year. How has that changed your business model? And, is it you have to be more resilient because of it, or is it just quite helpful from an energy demand perspective?
Yeah, there's the physical processes around it that probably has to be more resilient, and then you build somehow either safety stocks or whatever. And then I think as probably the third factor on it, the human leadership resilience is much higher. I remember the first day in 20 when we had a lockdown. I mean, people were running around. How are we going to get through this? Is the world going to stop? And today, if you have something like the Hormuz, you have your core partners close to you, and then you say, how are we going to work around that? So therefore, the resilience of leadership, I think the pulse maybe still goes a little bit up with certain part of the organization, but you are used to find solutions and mitigations to nearly every possible challenge these days. So I will say for us that are constructing in typically more than 30 countries at any given point in time, we find a way to get around that corner as well. And of course, as coming out of a second quarter here and guiding higher in the year, it bodes well that the world is adjusting these plans and the supply chains.
Do you see a potential challenge from China in that I think they provide something like 70% of global wind, even though Europe dominates in Europe? Is that a threat going forward?
I would say we've been around each other for a very long time. I think there's two things you can always say. Is this an asset without anything else than a tower and a nacelle and a blade? But it's probably what is inside. So when you have the software, you have the cybersecurity, then suddenly it's a different story. So I think there will be also in the world right now, which you've also seen in the last couple of months, where people are saying, actually, we go as far as this, and then beyond that, when it comes to components, when it comes to potentially inverters and others, we say, actually, we need homegrown. And I think that probably is pushing a bit more to your geopolitical angle of that you will see a further regionalization, also how you are sourcing your critical infrastructure.
What does that mean for price pressures? You got that 10% margin goal? How quickly do you get to that, or is the price pressure story kind of hemming that goal right now?
And I think there's just two things here. If price pressure was that the underlying and the end product we need is electricity, if that was trading or energy was trading low, then of course the price pressure would be different in that context. I can't see that happening. I've now sat here, as you can probably see on I've been here for quite a number of years, and every year you see the forecasted energy price 10 years out has always been energy prices coming down. I think the world has come to the conclusion saying it's probably not going to happen. So when you sit with some of these forward-looking price auctions and where you're sitting and bidding, I think there is a more and more the stability of saying probably it's not going to happen. There isn't an easy way of constructing electricity. If you go down the nuclear way, which I think most countries will be doing over the coming decade, then the price point will sit somewhere around 2-3 times higher than what is from the renewable industry. So therefore, the combination of more of all of the energy sources is not going to lower the energy price or the electricity price. It's just going to keep the stability for the supply. And come on, society without energy these days, hey, take a heat day here in London without air conditioning.
We're going to need more of that, definitely. Definitely. Henrik, stay there. I want to bring in Vincent Clerc, who is the CEO of Maersk. Maersk out with numbers this morning, another Danish firm, certainly smashing it on the upside. The company raising its guidance again on higher freight rates. Vincent, let me just come to you first. I just want to get your take on a conversation that we are having here, and that is about this idea that we are just going to see supply chain volatility. We are going to see bottlenecks causing problems pretty much everywhere. We're talking about Iran right now, but it could be Panama, it could be the Rhine, it could be rivers in Europe. Vincent, Your company is under a lot of pressure at the moment, not because of the good numbers you're posting, but because of the worries about the sustainability of those numbers, whether or not freight rates come sharply lower. And I'm wondering whether or not you think, actually, to carry on the conversation they're having at the moment, whether or not we're in a permanent state where somewhere or other there is going to be a bottleneck that keeps freight rates relatively elevated. What is your view of that situation at the moment?
I think what is happening right now is, of course, when we talk about this, we go a lot to these big events that happen, Hormuz closure, low water on the Rhine, things like this. But the underlying current is very, very strong, resilient demand for container transport on the back of electrification, whether it is generation, storage, new products such as electrical vehicles, data centers, cooling, anything that has to do with that is growing. The fabric of what we're moving is changing, and the volumes are growing very fast. And what we're getting to is actually that we are, for the most part, stretching the capacity that the global infrastructure has to support the level of volume and activity that we have. And this is not a question of ship. This is not a question of Hormuz or even climate change. This is just physical terminal capacity that has come online at a lower pace than volumes have grown for 15 years since the financial crisis. Rail and trucking power or infrastructure in many places that have been underinvested for too long. And we're seeing these bottlenecks. And COVID was a warning sign that when suddenly you have a surge in volumes, the land side cannot cope. Now we don't have the pull from COVID, but we have had 4 years of very strong growth in the market, and we're starting to hit some of the same bottlenecks, different places in the world. We're seeing it in Africa, we're seeing it in Brazil, we're seeing it to a large extent in Europe as well, and we're seeing it in China, which is a new phenomenon. Today, ships are waiting about 12 days outside Shanghai to be worked because the terminal is so congested by the level of activity that there is. And this has not happened before. And with the resilience in this demand, if this was to continue, then we will see these environments of bottleneck becoming prevalent for a long time. And that's what is leading to these rate events that we have seen, or these pricing events that we have seen as the market tries to cope with these disruptions.
Henrik, you guys work together. You work together. You got a deal on containerized freight. You're working now on warehousing. He's painting a picture of just ongoing volatility. How much deeper do these kinds of relationships need to get? Like, how big a challenge is it going to be? What can you do to mitigate some of this? Are these challenges going to be an ongoing issue when it comes to meeting that margin target that Tom was talking about just a moment ago?
No, but that's a little bit of walking back into memory lane. I think most of these partnerships either are founded under some kind of pressure. Because when you're really in the need, that's where people sit down and saying, so what's the real value of what we are doing together? And I think for us, that started some years back as part of this. Yep. And of course, Vincent has an ability to cover most of the world we need to be covered in. And therefore, it was also natural to sit down and saying, so what's the capacity? How do we also give Vincent an opportunity to plan that we don't run every 6 months somewhere else? So he can capacity plan, and he knows most of our routes because we don't change our factories from one day to another. So the inbound for us is super critical to get on time because we can't storage a month of production in components at the factories. So Vincent is the one that has to hold that for us. So and I think probably it's fair saying, Vincent, in the last year we haven't been forced to call each other that many times, which I think is a testament, first of all, to the two operations teams that can mitigate most things.
Okay, Henrik, thank you very much indeed. Thank you on the back of very strong earnings for Vestas, but also being, of course, one half of this Denmark focus for us with that lens on the global economy, of course, and trade. Henrik Andersen, the Vestas CEO. We're still with Vincent. Of course, Vincent, thank you for standing by, for your patience. Can I just very briefly summarise a view then from you? I mean, push back if you want, but is your take then that, look, freight rates higher for longer?
I think the freight rates will continue to be volatile, as they have been very volatile the last 6 or 7 years. They will continue to be volatile, but I think the general environment for the years to come will be more benign as long as the market continues to be as resilient as it has been for the past few years. Just because we are reaching some of these bottlenecks and we are starting to stretch the capacity, and we're seeing more and more events here and there, and certainly these disruptions will be more prevalent in the future. So yes, we're thinking that continued volatility, more benign environment, and therefore a better outlook for the segment.
And you gave us some colour on the China story with that wait of 12 days, I think you said, outside of Shanghai. What is the volume growth looking like for China going forward in the quarters ahead?
Yeah, so, I mean, what we see outside the fact that demand is resilient is that demand is more and more coming for exports out of Asia. We have a market that is growing for the year at about 4%. But we have the Far East market is growing just in the second quarter with the disruption of the Middle East has grown as close to 6% for export for the Far East to the world. So trade is becoming more and more imbalanced, which is exacerbating some of these imbalances and need for infrastructure to adapt to actually a different trade flows, different levels of balance. It's creating certain cost pressures, but it is also accelerating, exacerbating some of these bottlenecks that created the rate environment that we have. So certainly the Asian export machine is humming right now very, very strongly, because a lot of the stuff that we need for cooling, for electrification, whether it's grid or production or distribution or the products that use it, a lot of it does come from Asia, does not have substitutes outside of Asia, and will continue to drive demands as long as electrification and data centers becomes or continues to be a big level of demand.
I mean, if there's still this reliance on Asia, I guess, does that go against the story that we've seen kind of more regionalization, deglobalization in the last few years? Or, you know, what's your take on how that evolves?
I think you're right. There's been a lot of talk about regionalization and deglobalization. If you just look at the container statistics or trading statistics for the past 10, 15 years, you cannot see that in the number. What you see is an increasing dependency on Asia for imports from the rest of the world. And that is true across all regions. It doesn't matter if you look at Europe or emerging markets or even North America. There is an increased reliance on Asia for a lot of the products that need to come from there. And a lot of the focus when it comes to regionalizations is on key components and key parts that are not necessarily what is driving a lot of the global trade, but that have a disproportionate strategic value to be produced close to home or at home. And this is, I think, one of the misunderstandings between the components that are key, that hold high strategic value, and what actually drives the volumes and trade. There is a dichotomy there that I think the current dialogue is missing on, and the numbers that we're presenting and that we've been presenting for the last 3 years certainly show that this is so far going only one way, and it is more and more a reliance on Asia from the rest of the world, and specifically China to a large extent.
I mean, I'm quite surprised by that, and it's super interesting. Thank you. I mean, I'm also interested to get your take on China's launched a new shipping route through the Arctic. As you've had these kind of choke points come under pressure, is that something that you'd be looking at?
I mean, we're always looking at, of course, most effective ways to move goods from where they originate to where they need to be. As it is today, we don't see the Arctic route beyond having a ship here or a ship there being really a substitute. It's unpredictable. It relies on sanctioned Russia to provide icebreakers and escort throughout those waters. It has environmental issues that are not properly mapped at this stage, and it is also very unpredictable given how the weather is. So at this stage, I think this is not necessarily something that we see, if you take the next 5 years horizon, as being something that is going to play a big role in shipping. If you look far enough in the future, who knows? But I think this is something we will have time to relate to later on.
Okay, Vincent Clerc, CEO of Maersk. Really appreciate your time this morning on the back of another upgrade to the forecast for that shipping giant, of course. Thank you. Coming up, talking of the supply chain challenges and the bottlenecks, extreme heat is crippling Europe's busiest waterways. As we've been discussing, the Rhine is at record low levels. You're seeing a live shot right now, risking halting cargo traffic on a key stretch of the river. Oliver Crook, our Europe correspondent, is live in Germany. Later, we'll bring that story to you and the details. Stay with us. This is Bloomberg.
Six minutes to go until the opening trade here in Europe. European futures are higher, 0.1% seems to be the narrative at the moment. S&P futures also a little bit higher, not by as much, but not going down, I think, is the critical thing this morning. We're holding our ground.
It's a pretty interesting day on a day when the markets are getting a bit of a lift from the more benign CPI picture. And yet we've just spoken to two CEOs who've said higher electricity prices, that was Vestas, longer term, that is structurally baked in at this point, was his view. And then the Maersk CEO suggesting essentially freight rates are going to remain higher because of the demand picture and the constraints around those shipping routes.
And that very much seems like the theme this week, right? You've got droughts, you've got water levels that are too low, you've got jellyfish going into nuclear plants. And so, there seems to be a lot of worry around energy in Europe that's just not reflected in equity markets. And I wonder if that's just, we've been burnt once. We expected second quarter earnings to be lower, and they just were quite strong.
We also turned the sun off last night for a little while. Skylar had gone to bed, so she didn't notice. So what do you think the big theme is today? Is it that, or is it the BOJ? Is it basically the signal coming out of the Takaichi government saying you can go now? Rates are rising, expectations are rising in terms of what the BOJ does in September.
I mean, we've been edging this way for a while now, right? So I don't think that's really the big story. I think it's just that economic momentum is strong, you have softer inflation, and that's positive for risk.
Okay, that's what we're going to be dealing with. Skylar's going to be back tomorrow, Friday tomorrow. 5 minutes to go until the market open. That's next. This is Bloomberg. Morning, how you doing? A couple of minutes to go until we start trading here in Europe. Feels a bit more risk on this morning. That certainly seems to be the theme that's coming through. Yesterday we were a bit more negative. Today we feel like we're bouncing back. There's a few good things happening in this market. You've got some upside after the close yesterday in US stocks, so that's a factor that you want to fold in as well. You've got a bunch of earnings that look pretty good. There's a lot of ex-dividends in the market. Just be aware of that as this market is about to open. When you look at some of the stories on the screens in front of you, a lot of ex-dividends. Eurostoxx 50 futures are up by 0.5%. FTSE futures are up by 0.4%. DAX futures are up by 0.4% as well. So it's not amazing. It's not Korean-style bounce back, but we are getting a little bit of a bounce back here in Europe this morning.
It looks like there's a little bit more conviction. And on the individual stock story, there's some interest as well. So we'll work through some of the names that are on our watch list this Thursday morning. We've been talking, of course, to the CEO of Maersk. They've raised their guidance again. They raised it in June. They've just raised it again. Freight rates and the demand story out of Asia. Volumes strength there for that shipping giant. So watching Maersk. Thyssenkrupp also getting a lift from particularly the defence spend and the spend on steel. So that company has raised its outlook slightly. Evolution, this is a potential takeover story of this Swedish gaming company. It's had a 695 Swedish krona per share offer from Candle Lake. So we're watching that on the M&A front as well. Evolution in focus, Guy.
OK, let's talk about what we are seeing and what we are anticipating. Futures pointing us positive. That certainly is what we are looking for this morning. I think the single stock story is going to be, again, quite interesting, as it has been all week. So a bottom-up kind of a market, maybe less of an index story. But let's see what the indexes are doing. We're expecting 0.4% initially at the open. We'll see what happens below the surface in a second. But let me give you the first look at what we are watching here with the opening trade. FTSE comes out green. A little bit of red, a little bit of green. We'll wait for it to settle and give us a better steer in just a moment. We are watching, certainly for the Danish market, I think, to go higher. That's not on the board here, but it'll be interesting to see broadly what we do. We're expecting 2.310, so maybe a little bit more upside over the next few minutes. But we're not actually quite getting that out of the FTSE 100. It's down by 0.2%. So we're getting a slightly more negative print than maybe we would have first anticipated. The CAC's delivering what we anticipated, 0.3. IBEX is up 0.3. AEX is up by 0.4. DAX, we'll wait for the DAX in just a moment to give us its verdict on what we are seeing this morning. The FTSE looks like a little bit of a laggard. I'm curious to dig below the surface and find out why, Tom.
Basic resources is your biggest loser across sectors right now. So that will be the factor for the FTSE 100. You're looking at a drop in prices across most commodities. Iron ore is the only exception to that story. But you've got weaker gold, silver, and, of course, the oil story as well as part of the energy mix. But when it comes to basic resources, copper, gold and silver are all under pressure. So basic resources, the biggest loser right now, down 2%. At the top of the list, the biggest gains coming through for banks, interestingly, up between 5 and 0.6%. Consumer as a sector having been under pressure yesterday, also coming back as well, up 0.6%. Travel and leisure actually ended up in positive territory yesterday, and that sector again is adding to gains. Tech also gaining 0.3%. And just on individual stocks, and Guy will get us more details, but Maersk is currently up 8%. So a strong reaction to that further upgrade for that shipping giant.
The miners are definitely weak. So the FTSE is down by net change 8 points. Rio's down 11 points. Anglo's down. So what I just need to double check is this a sector story? Is this a divvy story? But I think it's interesting to see that miners are under a little bit of pressure, as you say, this morning.
OK, let's get a broader take on these markets and bring in Fabiana Fedeli, sitting and waiting on set for our CI for equities, multi-asset and sustainability at M&G Investments. Fabiana, maybe we'll start with the here and now and then project into the weeks and quarters ahead. What is your level of comfort that stocks can kind of grind higher from here in this environment with all the challenges, the geopolitical challenges and the question marks about higher prices and inflation?
Morning, Tom. It depends on what you think of as stocks. If you're thinking about indices, I am concerned about the high concentration in some of the most commonly used indices in equities. I mean, if you think about Asia, there are 3 stocks that make more or less 1/3 of the Asia indices. If you think about the S&P, there's just over 20 stocks that made half of the market cap of the index. So I am concerned about that level of concentration, what happens if those stocks turn. But from a broader market perspective, I see a lot of opportunity. I mean, look at earnings. The earnings season has been strong, and interestingly, has been strong on a broad level. Has been strong from a geographic standpoint. European earnings actually now have one of the lower gaps in terms of EPS growth compared to the U.S., has been strong in the emerging market area. And also, if you look at the specific companies, there are some real outstanding winners that are not actually in AI. And so there's a lot of comfort that you can draw from that.
How comfortable are you with the view that those earnings and that earnings strength can continue in an environment of higher gas and high oil prices for Europe?
So that is clearly something that we have to watch, because some companies have proven very resilient to higher energy prices. Let's not forget that companies, particularly in Europe, have learned their lesson since what has happened with the Ukraine war and the gas curtailing. But there are other companies that are just still very exposed to energy prices. So it's really important to make a difference in your portfolio where you see a potential exposure versus companies where you see more resilience.
Are you surprised that earnings are as strong as they are? It feels like the consumer, at the end of the road, everybody's a bit more unconvinced about what is happening here and a little bit more cautious. Yet earnings are absolutely booming right now.
I'm positively surprised by some of the earnings.
Yeah.
The one thing that, however, you continue to see is companies, even in the same sector, continue to perform very differently, even on a fundamental level. So how company management has actually innovated, how they have responded to their customer needs, and, of course, how they've made their businesses more resilient. Constant changes, right? We have changes in the supply chain. We have changes in the cost of inputs. That has been absolutely key for earnings.
So you got a stock pick?
Yes, always. Always, Guy.
Do you outperform stock picking, or is the index just... The index movements, are they just strong enough that that's what you do?
I think you can outperform the index in these markets. And especially you can create a better risk-adjusted portfolio, right, where you're not exposed to such a small group of very
those
large
are two different
stocks.
things. Can I outperform the index and be risk-adjusted?
Yes, you can.
Okay, that's easy to do?
No, it is not. Actually, it requires a lot of work. And that is probably why in the asset management industry you see many more investing in research, right? In proprietary research, in in-house research. And that remains one of the key elements to outperform in this market.
What's looking under-owned right now?
So many of those AI losers that actually you have seen outperforming over the last couple of weeks, I think they're still under-owned. So there was this big concentration on the AI enablers, and some of them are still very valid investments. But at the same time, some of the stocks, for example, in the software area, you've seen a couple of really strong earnings results coming from software. And those were the companies that were caught in the SaaSmageddon, and their earnings were strong, and at the same time, their pricing was weak. And also some companies that are using AI in their operations, and you're starting to see the impact of those changes on their costs and also on their revenues.
How are you thinking about some of the other underloved sectors in Europe, like the auto sector? Is a sector like luxury looking a little bit more resilient now? How are you thinking about particularly sectors that are exposed to the Chinese story?
So we actually like some of the stocks. We don't like all of the stocks. And interestingly, on the auto sector, some of the companies in the auto supply chain have shifted, and they're now in the data center supply chain. So some of the connectivity companies, some of the component companies have found another market. And the market or the financial market hasn't really appreciated that.
As an equity investor, how much time should I spend worrying about what bond yields look like?
So this is very interesting because you've seen the bond market and the equity market like doing their own thing, right, separately. And actually, it appears that equity markets haven't really even followed the energy price changes.
Yep.
However, there's one area that we have to keep an eye on, and that's credit, particularly credit for the large AI hyperscalers, for some of the AI companies, because some of that CapEx is being financed by credit. So what do credit investors think of the quality of that credit, and will they continue? I'm sorry?
What do you think they're saying right now?
I think they're thinking that there is a lot of supply in the market, and you're seeing some of the pricing probably being a little bit below what the credit rating would make you think. And so there is some unease in the market, not for all companies, and we have to continue to watch that. There is a nexus there.
When does it become unsustainable? In terms of the leverage and the circularity of some of these deals, is there a tipping point? Is there a red flag? What's kind of the canary in the coal mine? What are you watching for specifically when it comes to that story? Is it the CDS? Is it the spreads?
Timing is everything, right?
Yeah.
And you can't call it too soon because you're gonna miss some opportunities. So at some point, we're going to see a reversal of the quality of the balance sheets of some of those companies. And you're starting to see some off-balance sheet areas that are starting to become a little bit larger than many would like. And that is really one of the areas that you have to observe, how big these off-balance sheet deals are becoming. And not all companies will be the same. There is another thing. The hyperscalers can decide to switch. So when they feel that there is too much pressure on their balance sheet, they could decide to bring capex down, but that will hurt the supply chain.
Or issue equity.
Or issue equity, yes. And then at that point, it is on the plate of the equity holder to decide what to do.
Is that, for a long time, capital, the availability of capital has not been a problem. There's plenty of liquidity out there. You can get capital. You can do whatever you want. Has that now changed?
Not yet. Not yet. You see a lot of capital still around, but also you see not many other options. I mean, if you think about a lot of the capital that used to go to fixed income markets, for example, on the long end of the yield curve in developed market bonds, I mean, that capital feels pretty jittery, and some of that is moving to other areas. So there is still plenty of liquidity.
On that long end story, then, is high yields at the long end, is that more of a story of fiscal spend or AI issuance? What is the biggest driver there? Do you assume that there is further steepening in the yield curve?
They could well be. I mean, especially when it comes to fiscal spending, right? It feels like the bar for investors in bond markets has been set higher, particularly in the U.S. I mean, you've seen in the last few weeks, actually, U.S. yields at the long end of the curve have underperformed, have risen more than in other markets. And that means that bar has been set higher.
Fabiana, nice to see you. Thanks for coming to see us. We always appreciate it. Fabiana Fideli, CIO for Equities, Multi-Asset and Sustainability over at M&G Investments. We were talking earlier about what's happening in London. 23 stocks, I think, in Europe are XD. Number might even be higher, but HSBC, Shell, Rio, BP, GSK, Equinor, NatWest Group, London Stock Exchange Group, Halion, they're all XD, which is partly why we're seeing some of the sort of right side drop that we're getting in the London market in particular. So the core six looks like this, just to give a quick view of kind of what the picture looks like more broadly. As you can see, broadly we are higher. LVMH, Rheinmetall, ASML all up this morning. Nestle's even having a good day. Schneider's a little soft. Can't see that on my list of ex-dividends. But broadly, what you're getting this morning is a front foot move. London may be looking like it's underperforming. There's a lot of XD in there. So let's turn back to some of the stock stories that we've been watching so carefully this morning. AP Møller Maersk, certainly on Alex Morgan's radar.
Yeah, good morning, Guy. Yes, Maersk up around 8%. Of course, I mean, you spoke to the CEO there talking about that continued demand coming from Asia. We're seeing this morning's raising its full-year outlook for the second time in 7 weeks. And one thing that's particularly interesting, when you look at the disruption to the container routes and this aim for firms like Maersk and others to look to the Red Sea, is where things might go. And Maersk saying that they still see the industry overall growing 4% this year. So the mood music, very positive, wind in the sails, if you excuse the pun. But Maersk, obviously, they're transiting, I think, looking at some of the stats here, 1 in 7 of the containers globally. So you can expect to see, I think, a bit of a positive effect maybe on some other container shippers as well. Let's switch over to Adyen, the payments firm, the Dutch payment firm, up around 10% this morning after its first ever acquisitions, lifting that firm into the green this morning. Adyen up around 10%. Let's turn to Pandora, which lifted its full year outlook up around 5% this morning, also in the green. And Pandora, of course, makers of jewellery. They've had some positive news out this morning. Ørsted, though, the wind energy firm, they are experiencing a bit of a headwind, if you like, down around 2% this morning. Some challenges there. We'll be unpicking that through the day. And let's just finish with Evolution. Now, of course, we saw Candle Lake's mandatory cash takeover offer launched for the betting company. Well, they're down around 1% this morning. It's an interesting picture there, but of course, we'll be keeping an eye on that. But just to keep an eye on Evolution, they're down and in the red as trading gets underway this Thursday morning.
Alex Morgan, thank you very much indeed on some of the stocks on the move this Thursday. Coming up, a new EU initiative, meanwhile, looking to spur its stock-shy households into investing. More on that story and what they're proposing. This is Bloomberg.
I think the freight rates will continue to be volatile, as they have been very volatile the last 6 or 7 years. They will continue to be volatile, but I think the general environment for the years to come will be more benign as long as the market continues to be as resilient as it has been for the past few years. Just because we are reaching some of these bottlenecks and we are starting to stretch the capacity, and we're seeing more and more events here and there, and certainly these disruptions will be more prevalent in the future. So yes, we're thinking that continued volatility, more benign environment, and therefore a better outlook for the segment.
Maersk CEO Vincent Clerc speaking to us a little bit earlier on, just talking about that benign picture. Benign for him, i.e. we're going to see higher freight rates maybe going forward. There's going to be volatility somewhere, and it's going to keep prices high. As you can see, the market is responding reasonably favourably to those numbers this morning. A.P. Møller-Maersk up by 7.2%. Hapag-Lloyd also out with figures, also higher this morning, not by as much, but certainly looking fairly favourable for the shipping sector. Two companies delivering good numbers this morning, and it's that outlook statement, I think, by A.P. Møller-Maersk that is really lifting the share price. Brendan Murray, who leads our global trade coverage, here with us. What do we take away from this? Maersk, Vincent was sounding really quite positive. Yes, we may get a change in a shift in the landscape when it comes to Iran, but there's bottlenecks everywhere right now causing volatility.
Yeah, exactly. What he basically said was we certainly have a lot of supply shocks, but demand right now is very, very strong. We're looking at two companies that account for about a fifth of global container volumes, Hapag-Lloyd and Maersk, and both of them today, the signal from them is we had a difficult first quarter, things stabilized and got strong in the second quarter, and now they look to be sustainable through the rest of the year. So what this tells us is essentially global trade is resilient to all of these shocks, whether they be extreme weather, tariffs, or wars in Ukraine and in Iran.
He was really very clear on the demand story out of China and really underscored that in terms of a here and now question, but into the future as well, and just how reliant the global economy is, particularly when it comes to renewable energy, but all sorts of components. He's unquestionable that how exposed and how much demand we still are going to see. And in terms of our reliance on China, which really stood out. Yeah, exactly. He said it's all about electrification and AI, basically, and that the composition of the cargo that they're carrying is changing because of that. You know, we all thought that the shift from a goods-based economy to a service-based economy was gonna leave these sort of old economy companies like Maersk, behind. But in fact, we're seeing that just the opposite is happening. They are finding new markets and new kinds of products to deliver for their customers.
We're going to go to our reporter, Ollie Crook, who's on the Rhine this morning. What's the latest in terms of what we're seeing at the moment?
Yeah, I mean, from the St. Lawrence Seaway to the Danube, inland waterways are really shallow right now, and that particularly for Germany, which is heavily reliant on the Rhine to move cargo to its industrial areas and out through the ports. This is causing some difficulties with congestion. It's also raising the price of freight. And it's shifting things to trucks and trains, and so again, it's another supply shock that they have to deal with. It. You look at the Panama Canal; there are restrictions, tonnage restrictions there too that are and they're adding surcharges because of that. So the drift here is higher when it comes to freight rates across the board.
So this is the new normal, Brendan, right? In terms of the climate crisis and what it's doing, droughts, and what it's doing to river levels. Geopolitics, arguably, that uncertainty of volatility. So how does that change trade in 1, 2, 3, 5 years' time? What does our global trading system look like?
Yeah, it's one that's going to need to have redundancy built into it. You're seeing companies having to have not just one extra supplier, but 3 or 4, especially with what's going on with the Strait of Hormuz right now. You're seeing what used to be a big transshipment hub in Dubai have to sort of diversify around the region because of that particular strait. So whether it's a war or a typhoon or some sort of freak weather event, these are the kinds of things that if you're doing business internationally, you're shipping goods around the world, you're going to have to account for things that you can't really predict, like the weather or geopolitics.
Brendan, thank you very much indeed. Brendan Murray, of course, who leads our trade coverage here. Meanwhile, to the equity story, to the financing story and capital markets, European households, on average, invest much less compared to their US counterparts, keeping less than 10% of financial assets in directly held stocks, less than 10%. The EU is now pushing to change that with plans for a new savings and investment account. The bloc seeks to develop a public desire for stock and bond markets and pump money into businesses across the region. Let's get more details and bring in Bloomberg Global Finance reporter Laura Noonan. It is pretty startling, isn't it, the gap between how much exposure European households have to equities versus their US counterparts. This is a cultural shift that is needed as well. What is Europe hoping to achieve? How realistic is it? What is the plan?
So I think what Europe is hoping to achieve is, I think getting to the US level is probably a long way away. What they're hoping to achieve, though, is where European investors take some of their 11 trillion, which they have in bank deposits, and they put
11 trillion euros.
11 trillion euro
in bank deposits.
In deposits, most of it earning pretty much nothing. And what they want to do is get some of that to work in the European market, and that's a key thing as well, because they want people supporting European businesses.
That's the so. In some ways, this is not about European consumers. This is about getting the European economy going. Is it?
It's kind of about both. And that's one of the complexities is they're trying to do two things.
Yep.
On the one hand, they're saying to households, OK, you are losing money by keeping your money in bank deposits. You will have more for your retirement, for your house deposits, if you buy equities. The other side is, though, arguably you do the best in the world if you bought the Standard & Poor's 500. Like, if you bought US equities, you do great. They don't want you to do that. They want you to buy European equities, which will help solve Europe's financing thing, because the main catalyst behind this is Europe needs the money. That is a fundamental thing behind this. Europe needs this money.
But you could argue that the US economy does well because it has that level of financial backing, therefore it can invest in AI and everything else. It gets very circular very quickly.
It can get very circular very quickly, but I think the main thing which they're trying to do is, as you said, Tom, it is a cultural thing.
Yeah.
If you talk to, and I talk to financially literate people in financial jobs in EU countries, and you say, would you invest money in the stock market? They have this perception that it's a cliff edge thing. You put it in, you might never see it again. Like, that is the innate thing. And part of it is because in many EU countries, there have been various state assets have been privatized, and people's only experience of market investing has been investing in these state private assets. They didn't lose all their money in these, but a lot of people lost a lot of money in these, and that has scarred, I think, generations as well.
Yep. What are the mechanisms? Are we talking about tax incentives? Are we talking about kind of ISA-style products in Europe and more of that? What specifically are they looking to change? Are they engaging with asset managers? Are they engaging with the financial sector?
So the challenge there is on the mechanisms. It's kind of whatever you're having yourself thing, which is typical of the EU, because the European Commission would love to have a common tax incentive across the EU. Unfortunately, the European Commission does not have taxing authority. So all it can do is tell member states they would like to see tax benefits, and how you want to do that is in the gift of the member states. As you can imagine, every US in particular asset manager is all over this, because they would love, like BlackRock, those kind of people would love nothing more than to help Europe achieve this goal. And the irony is it'll be probably US asset managers, not European ones.
Do you think it's going to work?
I would give it a 60-40 in favour of working, but it does depend.
It
does depend on what your definition of working is. Like, we're not getting the whole 11 trillion. So I think 60-40, we will see a meaningful shift in Europeans' propensity to invest.
Okay.
But that's all I'm giving
That's a win.
Laura Noonan, really great reporting, really interesting. And, of course, you can get more details on Bloomberg.com and on the terminal. Coming up, Swedish coding startup. Meanwhile, Lovable hitting a valuation of more than $13 billion after a fresh round of fundraising, $400 million or so. We're going to speak exclusively to the CEO and co-founder of that business, Anton Asika, arguably the fastest growing software company in Europe right now. That interview is next. This is Bloomberg. This is the opening trade. We are 30 minutes into today's session. Happy Thursday. Some of the earlier optimism that we'd seen across the European equity space has faded a little. You're seeing gains of just 0.1%. It's a decent session over in Germany. The DAX is up 0.4%, just 12 points gained for the CAC current, of course, over in France. The FTSE 100 is down 0.5%, but there are lots of ex-dividend stocks as well, so that's worth noting today, with the FTSE currently down 0.5% across the benchmark gains of just 0.1%. Guy, what are you seeing?
You think we'd account for that, wouldn't you? In terms of the volume, we're still a little light. It's the middle of August. shocker. 345 up, 232 down, so we're slightly on the front foot in terms of the narrative there. Stocks, single stocks, quite interesting. Maersk, certainly one of those stocks that we've been watching this morning. We spoke to Vincent a little bit earlier on, 7.27, 7.3% to the upside. Market likes the outlook. He sounds quite confident. The big fear here is that you get an end to the war in Iran with Iran, and you see a reopening of shipping and freight rates come down. He's painting a picture actually of congestion going forward, and that's going to keep rates high. AP Møller Maersk doing well. Antionat with numbers as well, doing fairly good as well, up by nearly 10%. Mandatum is also strongly to the upside as well. So you're getting some single stock stories that are moving. Downside, there are some there as well. Swiss quote is down by 10%. You're getting quite a big spread here. Also stuck with guidance this morning. Were we expecting more? Maybe. That stock is down by 2.43%. An evolution despite the M&A process that we're going through, down by 0.9% as well this morning. Earnings are dominating the narrative, certainly, I would argue, at the single stock level. Tom, what do you got?
OK, here's what else you need to know this morning. Oil prices taking a bit of a breather, snapping a 6-day rally as traders wait for signs of progress on reopening the Strait of Hormuz, while talks between the US and Iran on ending the war remain mired in stalemate. President Trump is betting once again that suffocating economic pressure will do the job. The yen strengthened modestly and Japanese bond yields rose slightly on news that Prime Minister Sanae Takaichi's government is supportive of a near-term rate hike by the Bank of Japan. According to sources, fears about yen weakness at the central bank and the government's desire to strengthen the impact of recent FX intervention are aligning them on the need to raise rates. Bloomberg has learned that Anthropic is in talks to buy startup Decart AI for about $6 billion. Decart's chip efficiency software would reportedly help Anthropic's infrastructure absorb more demand for its AI models. If finalised, the deal would mark Anthropic's largest known acquisition. And staying on AI, Swedish AI coding startup Lovable has raised $400 million in a new funding round, doubling its valuation to $13.3 billion, backed by the likes of tech giant Tencent and an EU investment vehicle. The fresh capital will enable Lovable to compete with larger rivals, arguably Anthropic and Elon Musk's SpaceX. Anton Seeker, CEO and co-founder of Lovable, joins us now. Anton, thank you for your time. It's a chunky raise, $400 million, a valuation, as we said, of north of $13 billion. On some measures, you're the fastest growing software company in Europe right now. What are you doing to deploy that capital? What does it allow you to do that you're not able to do right now, or are you just building runway at this point?
Good to see you, Tom. What we did since we started was we set out to let the people closest to problems create software. And now what we're seeing is that more and more companies are running a large part of their business on top of our platform. So that's really what we're investing in. And we're growing at a quite staggering pace. We have now more than 900 million visits to applications built on Lovable every single month. And there's more than 1 million new projects built every single week. And this is both new small companies that are building without having to build up large traditional software engineering teams that can use our interface, which is made to be as intuitive as possible, and still let you do all the really hard things in software development, from taking care of security standards, collaborating and evolving the software with the feedback loops from your customers. And I'd love to give you some examples of how both teams in Fortune 500 companies and mid-market companies are rapidly adopting Lovable to move faster as companies.
Yeah. And Anton, on the enterprise piece, I know this is becoming increasingly important for you and the team. How much growth are you seeing at the enterprise level? Are you seeing churn there? What is the competition like when you're bidding versus Claude Code and others in the space? What does that story look like for you right now?
So what we're seeing is that the building of software is just the beginning. And if you want, if you're a CIO that's overseeing IT, what you could do is you could have your engineers using the tool of their choice, and then you have to oversee a lot of software running in different ways. Or you can say, let's try to standardize this and lean into more heavy guardrails around the things like data governance, how you're connecting your software to all the different tools you're using. And for some of our enterprise customers, they're really leaning in, and they're seeing that building on top of a platform like ours gives them a lot of management overview of all the load-bearing applications that are built in one overview, and being on top of the security checks that you want to have as an enterprise company as well. And now, I'll give you an example. Last year, Lovable was seen and used a lot for prototyping. Customers like Zendesk, they wanted to really lean in and take us through all of their security and compliance checks. And now Zendesk, they're building load-bearing applications with mission-critical data on our platform. And that continues to be the case with really large companies like NVIDIA, Adidas, Deutsche Telekom have built thousands of applications on the platform. So we're growing really fast on the enterprise side, in relative terms, faster than the self-serve market.
Do you think, Anton, these companies are still in the experimentation phase? Or have they moved beyond that now?
Yeah, so we classify the projects that people are building in terms of exploring ideas, right? And building AI applications on the platform with just a few interactions without having to look at the code. And how many of those experiments go to load-bearing products? And I'll give you an example of one of many, many business leaders that have themselves used our platform to build out new product lines. So Nenad, he's the VP of product at a company called Nursa Health, and they're doing healthcare staffing. He built out a new product line for educating new nurses, so Nursa Study. And this was complete with the admin panel, scheduling, and certification for new nurses. And he was able to take that product, build it, and launch it with real users, right? And then he himself, since he really bought into this platform, has moved on to roll it out into the entire company, and they replaced more than 10 different SaaS tools that they used in the past, and saving, projecting up to $1 million in savings, switching over to applications that they build, they maintain, and IT has a great overview of what's happening in there.
And so therefore, that takes me to my next question, which is, what do you think of this whole kind of phenomenon, which is the SaaSpocalypse? You're kind of at the other end of the telescope on it. You're suggesting to me that it sounds like that is real, that these big software companies have a big problem. Is that correct?
I think the software market is just going to continue to grow. We've only built a small fraction of all the software that's going to be built. And every company right now, including SaaS companies, have an opportunity to really innovate and broaden their value proposition to their customers, create more value for their customers. And some are going to succeed, some are not going to succeed. And I just think it's a very competitive world that we're living in. So that's how the perspective that I put on it, rather than saying that SaaS business as a whole, they all have a tough future.
Anton, Elon Musk's Grok has come up with a new model, 5.6. On some measures, it's significantly cheaper than some of its competitors, Anthropic and OpenAI. Are we seeing a kind of a large language model, a frontier model, an AI model price war right now? And do you guys benefit from that?
Great question. So what we've been betting on since day one is model independence, and we can compare all these different models and serve the best trade-offs for our customers. And we love when there are new models that are coming out, open weight models, new frontier models from the labs. And we're definitely seeing this, I believe, a commoditization of intelligence, and building the right guardrails, the right abstractions that make people be able to use the intelligence with all the necessary checkboxes in terms of security, how this is connected to your business, and how it drives outcomes for your business is the best place to be in. Generally, when a model like Grok 4.5 comes out, my AI and engineering team are super excited to put it to the test and see in which types of user requests should we use this new model. In terms of the exact price per token, as you know, it's always been going down. It's gone down 2 orders of magnitude. We expect that to continue to happen.
Anton, Cursor, bought by Elon Musk for about, what, 60 billion US dollars. Have you, Cursor AI, which is one of your competitors, have you become an acquisition target yourselves? Have you had any conversations? Did you have any conversations with Musk before that acquisition or anyone else, Anton?
I'm not here to talk about interest in what the future of Lovable looks like. We are here on our mission to build the most intuitive platform to build companies and run companies on top of Lovable, where building the software is the beginning, and we have a long way to go to build out the full platform. So I'm not considering any of those directions at Lovable ourselves. And we're building the team from here in Stockholm mainly, but we're scaling globally with many offices, and that's what we're planning to continue to do.
Let me ask you about one of your new investors then, Tencent, Anton. Any plans to deepen that partnership? What does that partnership look like? Does it mean that you're eyeing the Chinese market? Could Tencent help open up the Chinese market for you? Is that something to be thinking about?
I just want to say Tencent, a great global brand where they have a large portfolio of products that are not Chinese, but they're really on a global market. And their expertise in building such brands and companies is why the reason we were excited to have them joining in this round. I can't comment on exactly how we're seeing adoption in China right now, but we're growing globally on a lot of untraditional markets. We're huge in Latin America, APAC, and we're continuing to see that growth and doubling down and expanding our workforce globally. And I hope to see Tencent being great partners in all of those different markets.
OK, Anton, thank you very much indeed for your time. Anton Asika, of course, the co-founder of Lovable, on the back of that $400 million raise. OK, coming up, as Europe bakes under its latest heat wave, we're going to have a look at the escalating economic impacts of these scorching temperatures. We're going to take you to the Rhine River, where we are seeing a big problem emerging. You can't get the barges through. It's going to have an economic impact. We're going to find out how that's going to be felt. That's next. This is Bloomberg. Welcome back to the opening trade. We are 46, almost 47 minutes into the third stage session. Gains of just 0.1% across the European benchmark. The FTSE 100 is down 0.4%, but there's a number of stocks here in the UK that are ex-dividends, so just bear that in mind. Oil, interestingly, is now down around 1.4% on Brent, so you're seeing a move lower in yields across treasuries and a little bit of money moving into some of the sovereign debt of the Eurozone. But yes, yields are down across treasuries and oil is a little weaker. Stocks up then on the benchmark, just 0.1%.
OK, Europe. It's pretty hot out there. I think we already know this. We've got our fifth heat wave. It is underway. I think it peaks today. It is having a major impact on the logistics industry. Low water levels in key shipping routes. We are watching those very carefully. Got wildfires threatening crops. Europe is being forced into a rapid adjustment. Our chief Europe correspondent, Oliver Crook, joins us from Kaub in Germany, where the River Rhine is at its lowest level, I understand, Ollie, since records began back in 1880. Talk me through the impact of what is going on behind you.
Yeah, absolutely, guys. So this is the Rhine River, which is one of the most important waterways throughout Western Europe and really all of Europe. It takes us from the North Sea through the Netherlands, through Germany, into France, and then, of course, into Switzerland. And then there are a series of canals that actually connect it to the Danube River, which then flows over to the Black Sea. And the issue here, and we end up in a very sort of small German obscure town of Kaub, because this is the shallowest point at the Rhine River. And at a certain point, it becomes impossible to traverse this particular point. And we're at the Kaub reading station here, where we can see the water levels. And actually, if we can push in behind me there, you can see that tower. And right now it reads 11 centimeters. The lowest we've ever got was 10 centimeters, and that was, about 3 minutes ago. And the sort of record that was set before that was back in 2018 at 25 centimeters. And as you say, Guy, these are records that have been going back for a very long time, since the 1880s. And we're getting record after record just this week, but of course over the last couple of years. The real issue is at a certain level, and I did just see a barge go by laden with a very small amount of what looked like coal. So some ships are going through, but a much lower and reduced capacity. The issue is also that the last time we reached this record back in 2018, that was in October. We're now in August. So if this goes on for another month, 2 months, 3 months, it's going to have a fairly substantial impact on the economy. How big? I think it's very hard to say. We have some estimates out from some of the houses. ING says that it could cost German growth 0.3 percentage points of growth, which is close to half of what we're estimating here in Germany for the full year.
Yeah, that's not insignificant, is it? I mean, 10 centimetres, 11 centimetres. I mean, essentially, it's nothing. I mean, for a barge to cross 10 centimetres, we're almost that stretch then is almost going to be fully blocked if this continues. Ollie, what is the ability for Europe and for these waterways to adapt? Yeah.
Yeah, and so just sort of an aside on that. So that water level is not, so it goes, there's an extra meter effectively right below that. So we're talking about at 110 centimeters from basically the rock bottom. That's from the riverbed. But anyway, that's some of the technical analysis I've had to get across over the last couple of weeks trying to observe this story. But for a lot of the companies, of course, the reason that they are on the Rhine is the fact that they can send things up and down it. BASF has a massive operation in Ludwigshafen that's a bit upriver from here. You also have, of course, Rheinmetall, named after the Rhine River, and Thyssenkrupp, who had earnings out this morning. And you should remember back in 2018, for BASF, for Thyssenkrupp, the Rhine water levels was part of the reason that they had profit warnings. They had to announce profit warnings. Now, as a consequence of that, they've adapted some of their sort of activities, but we've also had some legislation switching here in Germany where a number of the German states, the most powerful economic states in the southwest, highly industrialized, they've suspended the ban on driving trucks on Sundays in order to try to ease the flow of some of these materials. But again, we've heard from Thyssenkrupp over the last couple of days, they say already they're not being able to get some of their supplies, and from BASF also saying that they're not ruling out a potential force majeure this year as a consequence of the low water levels.
So ironically, the impact of climate change here is that we need to burn more diesel to ship this stuff rather than being able to push it up and down the Rhine.
Yeah. There are all these paradoxes within climate policy here, and I think that for those in the EU have continued to push forward on the Green Deal, continue to push on some of these initiatives, potentially this is a little bit of wind in the sail there because it's becoming harder and harder to basically say this is all abstract, that climate change isn't real. You're starting to see some real consequences, not just on industry, not just on the waterbeds, not just on the fact that you can't suck up water to cool nuclear reactors, but of course on deaths. We've had excess deaths this year in Europe attributed to the heat, upwards of 25,000 people, 11,000 of those just here in Germany. So it's becoming part of the big political debate in terms of the landscape. What's interesting is, of course, there's always a culture war dimension to this, right? We've just been hearing over the last couple of weeks, Marine Le Pen over in France, part of her campaign platform now is saying, you know, air conditioning for all. And of course, you look at the air conditioning levels in Europe versus North America, it's about 20% here in Europe of households have air conditioners, according to Swiss Re, 75-ish in North America. So again, this is going to be sort of accelerating that conversation. But as you say, Guy, the sort of perverse question about this is that a lot of the time you end up having to burn more in order to deal with the consequence of having burned too much.
Absolutely. Many paradoxes certainly involved in all of this. And I imagine in the future some fairly significant engineering going on maybe to fix some of these issues on that river. Oliver, thank you very much indeed. Oliver Crook in Calb.
OK, let's look ahead at what else we are watching throughout the day. It's an election, a by-election, at least here in the UK, in Clacton. We're watching that. 10 a.m. UK time. Euro area industrial production data crosses at 1:30 p.m. UK time. We round out the inflation story on the US with producer prices. That's at 1:30 p.m. And we'll get some Fed speak as well from Beth Hammett later and Tom Barkin. On the earnings front, we'll be watching Applied Materials aftermarket with their numbers.
OK. Rest of the day, what does it look like? Let's find out. Adam Linton's here from our Market Live team. What are you watching?
I mean, obviously, there's not a massive amount to get excited about, but obviously...
I got told off for saying that yesterday.
OK, well, so I'm going to get a slap on the wrist, it looks like.
Very exciting. It's going to be a really busy day.
OK, so what in terms of something that has been a standout this week has been AI trade. I think we've seen a real sign of improvement here now. So we're seeing, the CoreWeave results and Supermicro. Yes, they were good, but importantly, the market's willing to pay up for them. Some of these AI names, in July that kind of bottomed out, they're kind of on the rise. We've seen a bit of a valuation reset. And yesterday we saw, market cap outperforming equal weight S&P, something which it hasn't necessarily done recently. But also we're seeing the positive follow through into Asia now as well. So the Kospi, that's up and round up 30-ish% off its lows. We've seen kind of the tech basket of, South Korea, Japan, Taiwan. They're kind of grouped together. They're performing relatively well.
Adam, is it a healthier rally, given the shakeout that we saw in July? Does that suggest that the market instincts and the market reaction, there was an adjustment, it was healthy, the leverage story has been addressed in South Korea, this is a more sustainable backdrop?
Yeah, there's definitely, we don't know for certain yet, but there are definitely signs of that some of the exuberance, has had a bit of a reset. I think it's interesting the comments from Citadel earlier in the week. They're noticing that retail's now returned as cash buyers. We've seen the kind of deleveraging run its course. So I think there's definitely further momentum. But, we've had the earnings kind of back it up. And, there's not really too much in terms of macro headwinds on the horizon that we can see at the moment to really derail things.
Yields are going higher, aren't they? Isn't that a macro headwind? We've got a big 30-year auction coming through today.
It depends on what part of the curve you're looking at when you say that. But obviously, US CPI was an event risk that was passed yesterday. Yep. It was benign. That was enough to drag yields lower. We may have a little window now where risk assets are also supportive. But what I would say for the CPI data yesterday is that it's not the final say. Okay, we've got PPI today. That feeds into PCE. Yes, the bar for adjustment there is probably relatively high. But we've got one more jobs report. We've got one more inflation report before September. It's still priced at 40%. It could go either way at this stage. And, ultimately, we've got Jackson Hole as well. Mm-hmm. We don't know what Walsh will say, how much he'll say. But that kind of plays to this point. We just don't know the Fed reaction function at this stage. So definitely potential for repricing, and if you do get some more hawkish impulses, the conversation can easily change pretty quickly. I know my colleagues on the Markets Live desk, they've also been looking at the back end of the curve, and I think you've had Mark Cudmore on your show as well. He's pretty downbeat on how far back end yields can definitely rise.
We watched the 30-year auction later today out of the US. Mark Cudmore, talking of whom, is also quite bullish on the UK. And UK data, at least month on month, the GDP data was looking okay for the UK. Dropped at 7 a.m. UK time.
Yes, I need to try not to talk too much against my boss here because I know what's good for me. But yes, it was encouraging data. We have kind of seen this seasonal pattern where, first half UK does really well and second half it kind of tails off a little bit.
Is it just football effects, World Cup effects?
Yeah, the World Cup may have played a role, definitely. So, that's obviously not something that's going to be sustained. But I think we'll have a bit more of a better macro read on the UK next week. We get labour market data. Obviously, there's only the data quality issues there. But we've got CPI, we've got PMIs, which have been a key input into decision making. So we'll know a lot more this time next week.
Adam, thank you very much indeed. Am Linton from my MLive team. Peter Navarro, meanwhile, White House Senior Counsel for Trade and Manufacturing, will join Surveillance at 12 p.m. London time. Just flagging that interview for you.
OK. We're done. We'll be back tomorrow, Friday tomorrow. I think we've got UMISH data tomorrow, which I'm actually quite interested in as well, to see what effects is coming through in terms of consumer confidence. That's it for the opening trade. We have opened the markets. The Pulse is coming up next. Francine Lacroix very much in charge of the next hour. That's the picture for European equities this morning. London looks like a laggard. There's an awful lot of ex-dividend in that market this morning. Anyway, I'll hand you over to Francine. This is Bloomberg.